Hello everyone, welcome to the second video of the mini-series about analyzing transactions, and today I'm going to talk about main account categories. So in the previous video, I said there are 5 main categories of accounts. We have assets, liabilities, owner's equity, revenues, and expenses. And today I want to talk about each one of them more individually or in more detail. So the first one is assets. Assets are basically resources owned by the company, and that means that the company has the right to use them. Okay, there's many examples of assets. The most commonly, for example, is cash, supplies, intangible assets, for example, like patent rights, copyrights, trademarks, and so on. Accounts receivable, which is, for example, when we sell to a customer but they did not pay us yet, we consider that an asset. Prepaid expenses as well, and buildings, for example. Finally, we also have equipment. So this is the most traditional types of accounts that we have in terms of assets, but there's many more. Liabilities are debts that are owed to outsiders or to creditors. In other words, things that the company, that your business entity must pay. And here we have things like accounts payable. This is the opposite of accounts receivable. And accounts payable means that you bought something from a supplier, but you did not pay it yet, and therefore you're going to have to pay in the future. Notes payable as well, like checks or debts that you have, for example. Wages payable, which is wages that you have not paid yet, for example, and unearned revenues, which basically is, for example, that period that if a customer has paid you in advance but you did not yet perform the service, and therefore you own them a service or you own them the product. And therefore we call that prepaid expenses. But I will explain all these categories more into detail later on. So the third category is stockholders equity, which is the stockholders' right to assets of the business. In other words, is the right of the owners of the business to the assets that the business have. In other words, their property. Okay. Now this is a balance. It's a balance between two things: the common stock that the stockholders have. In other words, how much of the business they actually own, and retained earnings, which is previous profits that the company has earned. We also consider in this category dividends, which is distribution of earnings to the stockholders. In other words, when an owner takes money out of the business for his personal use. The fourth category is revenues, and here we have revenues are what? They're basically increases of assets and stockholders' equity that result from selling services or products to customers. In other words, revenues are basically money that you make from selling something to a client or to another business, for example. And here we have things like fees earned or fares earned or commissions revenues, for example. There's also, for example, rent revenue if you rent a space to another business or to an individual, for example. But this is always money that comes from selling or renting stuff. Expenses, on the other hand, is the use of assets or consuming services in the process of generating revenue. In order for us to make a sale, we probably have to incur quite a bit of expenses. We have to buy or we have to spend money in order to be able to create those revenues. And this is what an expense is. An expense is all the money that you spend, that you must spend in order to be able to generate revenues. Here's, for example, we have wages expenses or rent expense or utilities expense or supplies expense. There's indeed many different types of expenses you can have, and a lot of them will be personalized to the type of business you have as well. So to summarize, we checked the 5 different account categories and some examples that we have into them. If you have any questions regarding this topic, just let me know in the comment section below, and I'll see you on the next video of this mini series. Thank you very much.